Tech and SaaS Financial News Report, June 6, 2026. Disclaimer: the following report is for informational purposes only and does not constitute legal, medical, financial, or official advice. All content here is based on publicly reported news and analysis, and news is not financial or legal guidance. Do not treat any anecdotal stories or commentary as advice. They are meant to inform and provide context, not to direct any personal or business decisions. 1. Tech stocks break records before sudden market volatility. The technology stock market has delivered an exhilarating yet tumultuous performance in the opening days of June 2026, with major indices reaching unprecedented highs earlier in the week before abruptly swinging into a sharp decline by week's end. On Monday, optimism in the tech sector propelled the S&P 500 beyond the 7,600 mark for the first time in history, closing at a record 7,609.78 as investors cheered robust corporate earnings and the sustained momentum of the cloud and semiconductor industries. The Nasdaq Composite similarly soared to an all-time high early in the week, buoyed by strong performances from mega-cap technology stocks and a continued rally in chipmakers, many of which have benefited from the booming demand for artificial intelligence, AI, hardware, and software. This broad-based rally was underpinned by impressive results and optimistic guidance from key tech and SaaS companies. For instance, Hewlett-Packard Enterprise reported stronger-than-expected earnings and raised its full-year outlook, sending its shares sharply higher and contributing to the feel-good atmosphere that fueled the surge. Market sentiment was jubilant as investors, flush with renewed confidence, compared the tech sector's upward surge to a rocket launch, eagerly anticipating that valuations could continue climbing to new heights in the coming days. By midweek, however, a confluence of global and macroeconomic factors introduced pronounced volatility, exposing the fragility of the tech stock euphoria and reminding investors that even a booming sector faces challenges and corrections. Geopolitical tensions flared overseas, with conflicts intensifying in certain regions and an unexpected announcement of potential new U.S. tariffs on dozens of trading partners rattled market confidence. These external pressures, combined with a surprisingly robust U.S. jobs report that heightened expectations of interest rate hikes by the Federal Reserve, acted like gravity pulling on technology stocks after their steep ascent. Investors began reassessing sky-high valuations, prompting a wave of profit-taking that swelled into a broader sell-off by Thursday. Many high-flying stocks saw their gains trimmed as caution returned to the market, an outcome some analysts likened to a spaceship adjusting its trajectory after leaving the atmosphere, an expected but sudden recalibration. Chip stocks, which had led the charge up, experienced mixed fortunes. While Nvidia and Apple remained near record territory, other subsectors like memory chip makers and some cloud software stocks started to falter under the combination of buyer exhaustion and macro jitters. By Friday's close, June 5th, the tech sector faced its most abrupt downturn since last year's short-lived correction, as the Nasdaq slid nearly 5% and mainstream investors were jolted by flashing red screens across their portfolios. The tech-heavy index's drop ended its three-week winning streak and underscored how quickly momentum can reverse in such a growth-sensitive sector. Yet many market strategists see this pullback as a healthy correction after an extraordinary run-up, rather than a sign of longer-term trouble. The downturn, they argue, may ultimately strengthen the industry by cooling speculative excesses and paving the way for more sustainable growth ahead. Much like a rocket enduring turbulence before reaching orbit, the tech stock rally might have simply hit a patch of necessary resistance, and the long-range trajectory for technology and SaaS companies remains pointed toward further innovation and expansion. With fundamental earnings strength still visible and investors' faith in technological progress underlying long-term valuations, an underlying optimism persists even as short-term traders catch their breath. Subtopic: June 5, 2026. Tech rally stumbles amid interest rate fears. Tech stocks' worst day since October. On June 5, 2026, the tech sector was shaken by its largest single-day decline in months, as investors interpreted a surprisingly strong employment report as a potential harbinger of tighter monetary policy, sparking a broad-based sell-off of high-flying technology and software-as-a-service stocks. The Nasdaq Composite plunged nearly 4.8% by market close, abruptly halting its recent streak of record highs and handing the index its worst daily drop since last October's brief correction. Mega-cap tech champions like Apple, Amazon, and Microsoft, whose shares have soared to near stratospheric levels in recent weeks, saw their stock prices tumble, dragging down broader market indices and fueling widespread conversations about overheated valuations and an AI bubble in tech. Bond yields jumped as investors braced for the Federal Reserve's next move on interest rates, feeding the narrative that the era of easy money is well and truly in the rearview mirror and raising questions about how richly valued high-growth tech names would perform in a higher-rate environment. Despite the jolting descent, some analysts and investors were quick to point out that tech has weathered similar turbulence before, often emerging stronger and more grounded as the dust settles from this market shock. Many observers remain cautiously optimistic that the sector will regain its upward momentum, albeit at a more measured pace, once macroeconomic fears abate. Boom to gloom. Tech stocks crash back to earth after rocketing rally. 2. SpaceX's historic IPO plans ignite market imagination. SpaceX, the pioneering private space company founded by Elon Musk, has catapulted itself into the financial headlines this week by formally filing for an initial public offering, IPO, that could rank as the largest in stock market history, sparking a frenzy of speculation and excitement across global markets. SpaceX's long-anticipated move to go public is being closely watched by everyone from Wall Street investors to space enthusiasts, as the company reportedly aims for a valuation soaring past $1.5 trillion, a figure that would place it among the most valuable publicly traded companies on Earth from day one. The company's public prospectus, unveiled just days ago, has captured imaginations by detailing SpaceX's extraordinary achievements in reusable rockets, satellite communications, and plans for interplanetary travel. Yet, it also acknowledges that turning those lofty ambitions into profits remains a formidable challenge. Top analysts note that SpaceX's meteoric rise parallels the high-stakes nature of space exploration itself. Enormous investment up front, years of innovation fueled by visionary risk-taking, and a promise of astronomical returns on the horizon. This week's news of SpaceX's IPO has electrified the tech and finance communities, reflecting not just a vote of confidence in the company's rocket technology, but also in a broader idea that the next chapter of economic growth may be written among the stars, with SpaceX leading the way. The financial details revealed in SpaceX's IPO filing have been nothing short of jaw-dropping, providing a rare window into a once secretive enterprise that has already remade the aerospace industry. The company disclosed significant investments and bold projections, including first quarter 2026 revenues of $4.7 billion, up 15% year over year, and a plan to raise an eye-watering $80 billion in the IPO, raising eyebrows even among experienced market veterans. Yet, in a stark reminder of the challenges that come with breaking new ground, SpaceX also reported a net loss of $4.3 billion in that same quarter, highlighting that its relentless pursuit of innovation and massive infrastructure build-outs come at a steep short-term cost. Remarkably, SpaceX's lofty IPO ambitions continue despite its recent financial losses, signifying the immense investor appetite for companies that are redefining entire markets, even when those businesses have yet to turn profits. Industry observers compare the fervor around SpaceX's offering to the height of 1990s dot-com mania, albeit now underpinned by a tangible track record of engineering feats, the company's potential to open new markets in satellite broadband, space tourism, and even Mars exploration is being weighed against the uncertainties of such cosmic undertakings. SpaceX's IPO fervor also underscores a broader trend, the convergence of technology and space as a new frontier for growth investors, a narrative that has taken on an almost science fiction quality in the financial media. In addition to SpaceX, smaller space tech companies and ambitious startups are capturing headlines and outsized stock gains, showing that investor enthusiasm is not limited to Musk's juggernaut alone. For example, reports surfaced this week of a tiny tech firm unveiling a breakthrough space-ready battery capable of powering artificial intelligence, AI, data centers in orbit, a development that sent its stock skyrocketing by triple digits in a single day. SpaceX's colossal potential listing has effectively put the entire space economy in the spotlight, prompting analysts to consider how new technologies aimed at space exploration, satellite internet, and even colonization of the Moon and Mars could usher in multiple new markets. This thrilling blend of futurism and financial promise has been fueling a decidedly optimistic tone. The idea that space, often dubbed the final frontier, is fast becoming a lucrative investment frontier is giving tech investors and the public alike real cause to dream big and believe that sooner rather than later, human economic activity could extend far beyond our home planet's atmosphere. Subtopic: June 6, 2026. SpaceX highlights water scarcity in AI race. No water, no AI. Warning shocks investors. On June 6, 2026, SpaceX's latest disclosure about its upcoming IPO stunned both investors and environmental analysts, as the company explicitly warned that water scarcity poses a significant risk to future AI and computing growth, an unorthodox risk factor that has sparked widespread conversation. In an amendment to its public offering paperwork circulated today, SpaceX cautioned that access to adequate water resources is critical for cooling the massive data centers that power artificial intelligence, noting that droughts, local water competition, and regulatory restrictions on water usage could constrain its rapid expansion. This striking admission, essentially no water, no AI, casts light on a growing concern industry-wide, as the explosion in AI computing requires ever-increasing cooled server capacity, which in turn demands vast amounts of water for heat management. The candid commentary from SpaceX has been seen by market watchers as an attempt to preempt investor questions about environmental resource constraints and to burnish its reputation for transparency, even as it seeks sky-high valuations. The news underscores a broader realization that the tech race is not just about code and silicon, but also about physical resources and sustainability, a perspective that's forcing companies and investors alike to widen their focus. Far from dampening enthusiasm for SpaceX's IPO, this water warning has ignited discussions about innovative solutions, from deep space cooling systems to orbital data centers that might one day use the endless cold vacuum of space itself to manage heat, a fittingly futuristic twist in the company's unfolding narrative. SpaceX's thirsty AI. Will a water crisis ground the tech space age? 3. Legal showdown. Generative AI faces its first major state lawsuit. The intersection of technology and the law took center stage this week as the state of Florida launched an unprecedented legal challenge against OpenAI, the high-profile developer of the ChatGPT artificial intelligence platform, marking the first time a U.S. state has sued a leading AI company over alleged harms caused by its products. Florida's Attorney General filed a historic lawsuit directly targeting OpenAI and its CEO Sam Altman, asserting that the company's ChatGPT technology was involved in incidents of misuse that allegedly contributed to real-world harm, including violent acts that officials claim were influenced by the AI's outputs. This bold legal action, unveiled in a news conference with Florida's top law enforcement and legal authorities, is framed as a fight to enforce responsibility in the rapidly advancing AI industry and protect citizens, particularly minors, from potential risks associated with unconstrained AI systems. OpenAI has pushed back firmly, denying the lawsuit's claims and emphasizing that it has built extensive safety measures and guardrails into ChatGPT to prevent misuse. But the seriousness of the charges has set off alarm bells in Silicon Valley and beyond. This case is poised to test uncharted legal ground. If Florida's suit gains traction, it could set new precedents for AI accountability and trigger a cascade of similar legal challenges by other states or even federal agencies in the near future. The tech and business community is intensely debating the implications of Florida's lawsuit, which arrives amid a broader environment of increasing regulatory scrutiny of AI, both in the United States and internationally. Supporters of the legal action argue it's a necessary measure to ensure that AI companies prioritize safety and societal impacts over growth at any cost, likening the current AI boom to the early days of the automobile industry when regulations eventually made cars safer for the public. Skeptics counter that such lawsuits might stifle innovation and hold companies liable for misuse of their technologies in unforeseeable ways, potentially chilling the development of transformative AI products. What's clear is that the lawsuit in Florida has made AI governance a front-page issue, highlighting concerns that range from misinformation and hate speech to the impact of AI on children and the mentally vulnerable. OpenAI and other AI firms now face a delicate balancing act, needing to reassure both investors and the public that they can continue pushing the boundaries of innovation while embracing robust protections, transparency, and perhaps working with regulators to develop new frameworks for AI oversight. In a broader sense, Florida's legal gambit underscores the tension inherent in the rapid rise of generative AI technology, where enthusiasm in markets for AI-driven growth is colliding with society's need to manage risks and ensure these tools are used responsibly. The case is being watched as a bellwether for how the nascent generative AI sector will be regulated in years to come, with some large tech companies apparently responding proactively by tightening their AI ethics policies and stepping up compliance with emerging laws around transparency and data usage. While this legal confrontation undeniably casts a cloud over the AI sector in the short term, some observers see a silver lining. Clearer accountability and safety standards could ultimately boost public trust in AI, enabling more sustainable adoption of these tools across industries. Comparing the moment to a spacecraft undergoing stringent safety checks before launch, the tech community is gradually acknowledging that robust oversight and cooperation with lawmakers might be essential to ensure AI's revolutionary potential doesn't flame out, but rather safely reaches new frontiers for the benefit of humanity. Subtopic: June 6, 2026. Florida's bold lawsuit puts ChatGPT on trial. Landmark AI court case unfolds. On June 6, 2026, Florida's unprecedented lawsuit against OpenAI continued to reverberate across the tech and legal worlds, with commentators dubbing it a landmark showdown between artificial intelligence and the law. As the case moves into preliminary court proceedings, the state's top prosecutor doubled down today on allegations that OpenAI's ChatGPT knowingly allowed harmful content to proliferate, citing specific incidents where the AI allegedly provided dangerous instructions or misinformation that contributed to real-life wrongdoing, an assertion vigorously contested by OpenAI's legal team. The lawsuit is the first of its kind at a state level, and its potential ramifications are enormous, raising novel questions about whether existing product liability and public safety laws can be applied to AI algorithms, or if new regulations will need to be crafted in the wake of this high-profile case. Legal experts note that the outcome could set a blueprint for how companies developing AI systems must conduct risk assessments and implement safety controls, effectively establishing an industry standard by judicial decree if the court sides with Florida's claims. The mood in tech circles remains tense yet contemplative. The case has triggered a broader conversation about responsibility, and tech leaders are reportedly quietly coordinating on best practices, hoping to head off a wave of similar lawsuits by demonstrating good faith efforts to align with evolving regulatory expectations. AI in the hot seat. Will courts clip ChatGPT's wings or chart a safer flight path? 4. Alphabet's $80 billion AI war chest signals massive tech investment surge. Google's parent company, Alphabet, stunned the financial world this week by announcing plans to raise an extraordinary $80 billion to fund a dramatic expansion of its artificial intelligence capabilities, a bold move that underscores just how high the stakes have risen in the global AI arms race. In a Monday announcement, Alphabet revealed it will undertake one of the largest capital raises ever by a technology firm. combining a public stock offering and a private placement with heavyweight investor Berkshire Hathaway to generate the massive sum needed for its ambitious AI objectives. This mountain of money is earmarked for building out Google's AI infrastructure, an undertaking that includes constructing cutting-edge data centers, custom chip development, and the hiring of top-tier AI talent at an unprecedented scale, with capital expenditures for 2026 projected to reach nearly $190 billion. Alphabet's own CEO, Sundar Pichai, has characterized the situation in frank terms, recently telling investors that Google is compute-constrained in the near term as demand for its AI-powered services and products has outstripped its current computing capacity, and that only by spending vast sums to upgrade its hardware and networks can the company meet its customers' insatiable appetite for AI features. This enormous fundraising plan, which many have likened to mobilizing wartime resources for a moonshot, reflects not just Alphabet's confidence, but also its urgent conviction that in the new era of AI dominance, the companies with the deepest technological infrastructure will lead and define the future. The wider context surrounding Alphabet's $80 billion capital raise paints a picture of an industry in overdrive, with not just Google but all major tech giants engaged in an aggressive race to outspend and out-innovate each other in artificial intelligence. Collectively, Amazon, Microsoft, Alphabet, and Meta are expected to invest over $700 billion this year in AI facilities and capabilities, encompassing everything from advanced semiconductor chips to global cloud computing networks, as each company vies for the pole position in AI-driven services. Alphabet's staggering funding plan includes a $10 billion strategic backing from Warren Buffett's Berkshire Hathaway, a vote of confidence that has drawn parallels to the 19th century railroad boom, when tycoons poured fortunes into building tracks across America, betting that infrastructure would yield future riches. Even as Alphabet's stock experienced a short-term dip after the announcement, reflecting investor caution about dilution and the sheer scale of spending, the keen interest in the offering suggests strong market belief in the long-term promise of this investment. Indeed, the share sale was reportedly oversubscribed by eager institutional investors, indicating that despite the short-term cost, Wall Street sees Alphabet's move as necessary and potentially even conservative given the magnitude of AI opportunities ahead. Alphabet's massive AI funding gambit also highlights the interplay between ambition and responsibility in the current tech landscape, as leaders try to balance breakneck innovation with the trust of users and regulators. Some of the $80 billion war chest is expected to be directed at ensuring Google's AI models and services remain safe, ethical, and reliable, with significant spending anticipated on privacy technology, bias mitigation, and alignment research to keep AI systems beneficial for users and society. By amassing such a formidable stockpile of capital to fuel AI R&D, Google is essentially launching its own Apollo program, an all-hands mission to push the boundaries of what machines can do, from improving language understanding and healthcare diagnostics to enabling autonomous vehicles and smart infrastructure. This bold strategy, though not without risks, has injected a surge of positivity into the tech sector, as Google's commitment is being interpreted as a sign of just how bright the future of AI could be. Investors and developers alike are energized by the notion that with enough resources behind it, the next generation of AI breakthroughs could arrive sooner than anyone imagined. Subtopic: June 6, 2026. Market reacts to Google's AI spend. Short-term jitters amid long-term AI optimism. On June 6, 2026, market commentary continued to swirl around Alphabet's colossal $80 billion funding move, with investors digesting short-term market reactions and the long-range implications of Google's all-in bet on artificial intelligence. Initially, Alphabet's stock price wobbled in the days after the announcement, slipping a few percentage points as shareholders grappled with concerns about dilution and the sheer magnitude of capital costs, a natural knee-jerk response whenever a company issues new shares on such a scale. However, by today, analysts note that sentiment is stabilizing and even turning positive, with many pointing out that the oversubscription of the offering indicates robust demand for exposure to Google's AI journey, despite the near-term financial hit. Market watchers are framing the transient dip as a classic case of short-term pain for long-term gain, noting that Google's leadership in AI search, cloud services, and autonomous driving stands to be fortified by this infusion of resources. Comparisons are being drawn to historic tech spending sprees, from the building of transcontinental railroads to early internet infrastructure. And the consensus among many tech analysts is that the long-term returns from cornering the AI market could dwarf the costs, provided Google executes wisely. The immediate market jitters appear to be giving way to cautious optimism, and some traders have even started buying on the dip, believing that this rare combination of visionary ambition backed by substantial capital could further cement Alphabet's position as one of the colonizing companies leading humanity into a heavily AI-powered future. Google's $80 billion AI gambit, bold vision, or budget black hole. 5. OpenAI's path to a $1 trillion IPO, ChatGPT pioneer prepares for public debut. OpenAI, the company behind the wildly popular ChatGPT, is reportedly gearing up for a blockbuster initial public offering that could see it become one of the most valuable publicly listed companies in history, a testament to the extraordinary demand and speculation swirling around generative AI. This emerging AI titan has been quietly laying the groundwork for an IPO that analysts predict could value the firm at close to $1 trillion, putting it in the same league as the biggest tech giants despite being a relatively young startup. Over the past year, OpenAI has raised unprecedented private capital. One recent funding round closed at a stunning $852 billion valuation, after the company secured $122 billion in private investment as of late March 2026, an amount practically unheard of for a firm founded just a few years ago. Now, it has been hiring seasoned financial executives and bolstering its corporate governance structure, with a high-profile former CFO of a major tech firm recently joining to help guide the company through the complex IPO process. Industry insiders say that if market conditions remain favorable and regulatory hurdles are navigated, OpenAI could file confidential paperwork as soon as this summer and potentially go public by the fourth quarter of the year, giving everyday investors their first chance to own a piece of the AI phenomenon that has taken the world by storm. OpenAI's preparations for a public market debut come amid the company's rapid transformation from a research lab into a commercial powerhouse, reshaping expectations for what a modern SaaS and AI platform can achieve. Since its release in late 2022, ChatGPT has amassed hundreds of millions of users globally, now reportedly serving nearly 1 billion weekly active users, as individuals, businesses, and developers have flocked to the technology for everything from answering trivial questions to aiding scientific research and writing code. To sustain this explosive growth and court investors, OpenAI has been shifting focus to high-value enterprise applications, positioning its AI as a productivity tool for businesses in fields like customer service, software development, and data analysis. This pivot, which includes the development of advanced AI features tailored for corporate use and closer integration into Microsoft's cloud ecosystem, thanks to Microsoft's deep partnership and multi-billion-dollar investment in OpenAI, signals that the company sees massive monetization potential beyond consumer novelty. As it stands at the threshold of a possible trillion-dollar IPO, OpenAI is effectively staking its claim as a central infrastructure player in the future of the knowledge economy, akin to how foundational technology companies became indispensable during the rise of the internet. The prospect of OpenAI going public represents not just a financial event, but a symbolic milestone in the AI revolution, drawing comparisons to the transformative tech IPOs of earlier eras, such as Google's in 2004 or Facebook's in 2012. Market excitement surrounding OpenAI's potential listing is driven by its status as the undisputed poster child of generative AI and by its charismatic leadership under CEO Sam Altman, who has become a globally recognized figure for championing both advanced AI capabilities and calls for thoughtful oversight. At the same time, the possible IPO will be a delicate dance. OpenAI faces more scrutiny around the safety, ethics, and economics of its technology than perhaps any startup before it. And Altman himself has acknowledged the need to ensure the company's tools are aligned with societal values as it scales up. Still, the enormous valuations being discussed reflect investors' belief that the AI-driven transformation of industries is just beginning, and that OpenAI's platform could be the closest thing to a ticket to the future that stock markets have ever seen. If and when OpenAI's stock finally starts trading, it could well be one of the most consequential public offerings of the decade, both in terms of money raised and its cultural impact, marking the moment when artificial intelligence truly entered the mainstream. Subtopic: June 6, 2026. OpenAI's IPO buzz intensifies. Market awaits ChatGPT makers' next move. By June 6, 2026, the drumbeat of anticipation around a potential OpenAI IPO has reached a new crescendo, with prominent financial commentators and AI industry insiders offering fresh hints and insight into the company's timeline and strategy as the year's most anticipated offering draws nearer. Speculation is swirling across tech media today over reports that OpenAI has quietly hired several Wall Street heavyweights, including specialists in high-profile listings, to shape its public offering, reinforcing the sense that the company is leaving nothing to chance. The firm's CEO Sam Altman has maintained a measured silence on the subject of going public, but sources familiar with OpenAI's plans have indicated that the board and major investors are in intense talks about the ideal timing and valuation, with some pushing for a formal filing by late summer. Market watchers note that each new whisper or leak about OpenAI's progress toward an IPO sends ripples through the stock prices of its partner and competitor companies, Microsoft, Alphabet, and smaller rivals like Anthropic, demonstrating the far-reaching influence of a company that isn't even public yet. Enthusiasm among potential retail investors seems boundless, with message boards and social media abuzz about the possibility of owning a slice of the ChatGPT phenomenon, and some analysts even cautioning casual investors not to let hype blind them to the inherent risks, as OpenAI is still unprofitable and untested in public markets. Still, on this day the mood remains unabashedly optimistic, as many are comparing OpenAI's eventual IPO to a momentous launch, an analogy that feels apt, given how the company has captured the public imagination and could soon propel ordinary investors on a thrilling journey into the future of AI technology. ChatGPT goes to Wall Street, the $1 trillion question on everyone's mind. 6. Anthropic's quiet IPO filing raises stakes in AI rivalry. Anthropic, a leading AI startup known for its sophisticated AI assistant Claude, has stealthily signaled its own intentions to join the public markets, confidentially submitting paperwork for a potential IPO that could become one of the largest tech offerings on record. While lacking the name recognition of its larger competitor OpenAI, Anthropic has rapidly become a powerhouse in the artificial intelligence world, thanks to hefty backing from global investors and a reputation for cutting-edge AI research focused on safety and ethics. According to insiders, Anthropic's confidential S-1 filing with the U.S. Securities and Exchange Commission was made earlier this week under the radar, in part to avoid igniting too much hype or scrutiny before the company is ready to fully reveal its finances and business plans. However, even with minimal fanfare, the investment community has taken notice after recent funding rounds that reportedly boosted Anthropic's valuation to nearly $900 billion. Speculation is rife that its public debut could surpass even some of the world's most established tech firms in market capitalization. This small team of AI researchers turned entrepreneurs is emboldened by the immense enthusiasm for AI, and particularly by Claude's progress as a potent alternative to ChatGPT, and appears set on capitalizing on the market's ravenous appetite for AI exposure. Anthropic's potential IPO is part of a spectacular broader trend in 2026, a wave of technology companies racing to list on stock exchanges as the frenzy around artificial intelligence and software innovation hits a fever pitch. Within the AI sector, Anthropic's looming public listing is expected to intensify its rivalry with OpenAI, since both companies are vying to set global standards for large language models and secure the capital needed for expensive R&D and computing infrastructure. Anthropic, co-founded by former OpenAI researchers, has carved out a niche by emphasizing AI safety, its AI assistant Claude is designed to be more controllable and less prone to harmful outputs. And this has resonated with certain investors and governments looking for a counterbalance in the AI ecosystem. By harnessing public market capital, Anthropic could further accelerate development of its next-generation models, broaden cloud partnerships, and scale its business into new enterprise solutions, potentially challenging some incumbent SaaS and cloud providers. In tandem with the expected OpenAI and SpaceX offerings, analysts dubbed this period a trillion-dollar IPO wave, and they note that these events together could inject a surge of liquidity and exuberance into tech markets reminiscent of the late 90s internet boom, albeit grounded in the very tangible breakthroughs of AI technology. The mere prospect of an Anthropic IPO underscores how dramatically the global tech finance landscape has shifted in a short time, where AI-born companies can mature to nearly 12-figure valuations faster than any prior generation of startups. Traditional market watchers, from venture capitalists to seasoned public equity investors, are attempting to recalibrate their models and metrics to a new normal, recognizing that the rules for evaluating tech companies are evolving as AI-driven scale and network effects redraw possibilities for growth and profitability. This week's revelations around Anthropic have already prompted discussions in financial circles about whether we are witnessing a paradigm shift akin to the dawn of the space age, with founder-led AI companies like Anthropic blazing a trail into the unknown and investors chasing them in hopes of outsized returns. Yet, with such high valuations come equally high expectations and potential pitfalls. The company will likely face pressure to demonstrate clear revenue paths, defend its market share against tech giants, and abide by intensifying regulations that demand robust AI safety and transparency. For now, though, the narrative around Anthropic's secretive IPO plans is one of ambition and excitement, an example of how the AI industry's rising stars are no longer content to remain private when public markets are offering a chance at historic capital and influence. Subtopic: June 6, 2026. Anthropic's IPO filing revealed. AI competitor takes the leap. On June 6, 2026, financial outlets confirmed that Anthropic quietly filed for an IPO earlier this week, bringing its long-rumored public debut out of the shadows and thrusting the OpenAI rival into the spotlight of the investment community. The confirmation, previously only whispered about in venture circles, has now been substantiated by multiple reports, indicating that Anthropic initiated a confidential filing on Monday, June 1st, under rules that allow the company to keep detailed financials under wraps until closer to an actual listing. This move positions Anthropic to potentially go public within the next few months, and it comes on the heels of a tremendous funding round that valued the company at nearly $950 billion. A striking figure given that Anthropic was only founded a few years ago by former OpenAI researchers. Market commentators today noted how this development ratchets up the competitive pressure in the red-hot AI field, as investors will soon have the chance to directly compare the business performances of these two AI unicorns on the public stage. Shares of some of the tech giants aligned with the AI space saw minor fluctuations in response to the news, illustrating how even a hint of new competition from a company like Anthropic can send ripples through the broader market. Ultimately, the confirmation of the IPO filing marks Anthropic's graduation from stealthy startup to a forthcoming global player, suggesting that the era of AI-dominated public markets is not some far-off science fiction scenario, but an imminent reality, as yet another ambitious company charts a course for the stars of Wall Street. Stealth no more. AI upstart's secret IPO sets stage for massive Wall Street AI showdown. 7. NVIDIA's next frontier, from GPUs to AI-powered PCs. NVIDIA, the chipmaker synonymous with the AI boom, is boldly expanding beyond its traditional stronghold in graphics processors, GPUs, and aiming to upend the personal computing landscape, staking its claim as a key architect of the next generation of AI-driven hardware. This week, NVIDIA announced partnerships with major computer manufacturers like Microsoft, Dell, and HP to develop so-called AI PCs, supercharged personal computers equipped with advanced local NVIDIA AI accelerators and cutting-edge CPUs to run sophisticated artificial intelligence workloads right on desktops and laptops. The initiative represents a radical shift. After conquering the data center and cloud AI realms with its industry-leading GPU chips, NVIDIA now wants to bring AI processing power directly to end users, effectively turning everyday PCs into intelligent assistants capable of on-device language model inference, generative art, and more. Such a strategy could revolutionize personal computing, bridging the gap between cloud services and user hardware and empowering individuals and businesses with AI capabilities that were once possible only via remote supercomputers, a development often likened to the dawn of having a pocket rocket of AI power on every desk. NVIDIA's move into the CPU territory, once the exclusive domain of incumbents like Intel and AMD, is seen as the company's next frontier mission, a bid to capture a chunk of the $200 billion market for microprocessors that has long been outside its purview. NVIDIA's expansion strategy has significant financial and competitive implications for the broader semiconductor and technology industries. Over the past few years, the company's share price has soared by many multiples as it reaped the lion's share of profits in the AI hardware rush, turning it into one of the world's most valuable companies. Now, by unveiling plans to produce AI-optimized central processing units, CPUs, and integrating them into mainstream computing through alliances with PC makers, NVIDIA is effectively entering a direct competition with the likes of Intel and AMD on their home turf, raising the stakes in the global chip competition. This week's revelation follows an extraordinary moment at the Computex Technology Conference in Taipei, where NVIDIA CEO Jensen Huang garnered attention by proclaiming that one of its partner companies, Marvell Technology, could be the next trillion-dollar chip firm, which instantly sent Marvell's stock up by double digits. That show of force was matched by NVIDIA's own acquisition of a smaller AI software startup, as well as a new partnership with industrial giant Siemens to provide advanced battery systems for data centers. Moves that expand NVIDIA's ecosystem in ways that tie together hardware innovation and broader use cases like energy efficiency. All these strategic steps suggest that NVIDIA is aiming to be more than a leading chip supplier. It's positioning itself as an indispensable platform company for the entire AI era, from cloud to edge, and even into burgeoning domains like autonomous vehicles and robotics. Investors and consumers alike are abuzz about the possibilities unlocked by NVIDIA's commitment to pushing technology's boundaries, which aligns with a larger narrative of tech companies thinking in terms of ecosystems and end-to-end solutions rather than just standalone products. By envisioning personal computers as fully capable AI assistants, able to run complex models without needing constant internet connectivity, NVIDIA is acknowledging and harnessing the appetite for AI that functions seamlessly and privately for users. This approach has excited the market with a sense of futuristic promise. The notion of democratizing AI by embedding it into devices we use daily is a compelling vision. Still, some caution that the path forward could be challenging, as integrating powerful AI chips into consumer PCs must overcome technical hurdles like heat management, much like rockets need effective cooling during takeoff, and must convince users they need such capabilities. Nevertheless, the buzz around NVIDIA this week reflects a widespread belief that we are on the cusp of a new era of intelligent computing devices, and in pursuing this next leap, NVIDIA is once again playing the role of trailblazer, charting a course akin to a spaceship exploring new tech frontiers and beckoning others to follow in its contrails. Subtopic: June 6, 2026, NVIDIA and allies unveil AI PC prototype, a glimpse of smart computers. On June 6, 2026, tech insiders got an exciting look at the future of personal computing as NVIDIA and its industry partners showcased a prototype of their AI PC concept, revealing a desktop computer bristling with NVIDIA's next-gen AI processing hardware seamlessly integrated alongside advanced CPU and graphics components. This prototype demonstration, occurring at a private event concluding Taipei's Computex Week, conveyed in concrete terms what an AI-empowered PC might be capable of: real-time language translation, instantaneous image generation, and running sophisticated machine learning models locally without relying on the cloud, all packaged in a sleek and standard PC form factor. The unveiled demo PC boasted an NVIDIA-made AI accelerator chip that reportedly delivered supercomputer-level performance, allowing tasks like complex data analytics and automated video editing to be performed on the fly within an individual machine. Industry observers at the event were buzzing about the collaborative nature of this breakthrough. NVIDIA's alliances with marquee names such as Microsoft and Dell signaled that this is not a mere concept, but part of a serious push to redefine mainstream computers. Analysts say this demonstration cements NVIDIA's incursion into CPU territory and underscores a larger industry trend. Chip companies and PC makers are now working hand in hand to ensure that the next wave of computing will be AI-centric from the ground up, potentially ushering in a renaissance for personal computers. The live prototype wowed attendees and reinforced investor enthusiasm around NVIDIA's future growth prospects, as many now see the company not just as a GPU leader, but as a driving force behind a paradigm shift that could propel everyday computing into the AI age. Your next laptop thinks. NVIDIA's AI PC leaps from sci-fi to reality. 8. Cybersecurity shaken as AI-powered hacks target social platforms. A sobering wake-up call rang out in the tech industry this week as a major cybersecurity breach exploited the very AI systems that many companies use to automate support for their customers, highlighting that the same intelligent tools transforming business can also be manipulated by malicious actors. In one of the week's most startling developments, hackers reportedly used Meta's AI-driven customer support system to hijack a number of Instagram accounts, demonstrating a new and troubling vector for cybercrime. The scheme, which surfaced after numerous influencers and businesses suddenly lost access to their Instagram profiles, involved hackers tricking or manipulating the automated support bot, an AI that handles account recovery and user requests, into granting them control over the accounts. This incident underscores a growing challenge in the modern digital landscape where AI is embedded into critical services. Malicious parties are now targeting these AI systems themselves, finding ways to jailbreak or confuse algorithms into performing unauthorized actions. The result has been a flurry of concern among cybersecurity experts and social media companies as they scramble to fortify their AI systems against such exploits and reassure users that their personal data and online identities remain secure. The Instagram account hacking spree via AI exploitation carries significant financial and reputational consequences not only for the individuals and companies affected, but also for the broader industry of social media and SaaS platforms. Victims of the hack included small businesses, influencers, and even some tech startups who rely on social media accounts as part of their branding and customer outreach, and the temporary loss of those accounts had immediate implications. From revenue loss due to halted e-commerce operations to damage to audience trust and brand identity. For Meta, Instagram's parent company, the episode is a stark lesson in the double-edged nature of AI automation. The very technologies intended to improve efficiency and user experience can become backdoors for breaches if not rigorously safeguarded. This week, cybersecurity firms have reported a surge in attempted attacks on AI-managed systems across various industries, from banking chatbots handling account information to healthcare AI triaging patient data, raising alarm that these cunning intrusions might herald a new era of AI-targeted cyber threats. Investors have noticed, too, stock prices for cybersecurity companies spiked as the market bet on increased demand for advanced security solutions in the wake of the Instagram incident, while social media and tech platform stocks experienced a brief dip due to fears of potential liabilities and the cost of shoring up their systems. Ironically, this latest breach demonstrates that as AI grows more powerful and ubiquitous, it also becomes an attractive target, forcing companies to innovate defensively even as they push technology boundaries forward. The scenario echoes the classic arms race in cybersecurity, but now the weapons are neural networks and AI-driven automation. Leading security researchers and AI developers are doubling down on their efforts to create robust safeguards, like advanced anomaly detection and strict human oversight, to ensure AI cannot be easily fooled or repurposed by bad actors. Despite the immediate damage, some experts remain confident that these incidents will ultimately lead to stronger, more secure AI systems, comparing this learning curve to the way early space programs learned from rocket failures, improving designs after each crash and burn. In that sense, while the Instagram hack was certainly a stark reminder of new dangers, it has also injected urgency and creativity into efforts to protect the AI that increasingly runs our digital lives, reinforcing the need for vigilant security measures so that the benefits of AI can continue to be enjoyed without fear of exploitation. Subtopic: June 6, 2026. Instagram hack fallout. AI vulnerabilities under scrutiny. In the aftermath of the Instagram account hijacking spree, which came to light on June 6, 2026, executives at Meta and other tech companies are publicly addressing the incident and outlining steps to close the security gaps in their AI systems as regulators and customers demand answers and assurances. Meta's security team confirmed in an update today that hackers abused Instagram's AI-driven support chatbot to trick it into resetting account credentials, a sophisticated social engineering maneuver that allowed the attackers to commandeer dozens of high-profile user accounts. The revelation has spurred immediate action. Meta announced it is temporarily scaling back certain automated support features to implement additional safeguards and strengthen multi-factor authentication processes, demonstrating a commitment to patching the vulnerabilities and restoring user confidence. Meanwhile, the hack has drawn commentary from cybersecurity experts around the world, who warn that this method could be replicated against similar AI-based services across industries. Government agencies in both the US and Europe have reportedly reached out to social media firms to understand the risk, considering whether new security guidelines or regulations might be needed for AI and consumer platforms. Despite the seriousness of these events, many leaders and industry observers are finding optimism in the proactive response, viewing it as a necessary learning moment that will push tech companies to innovate better defense mechanisms. Every new technology faces tests and setbacks, they note, and like a space mission that encounters meteors, the key is adaptation, ensuring future AI deployments are hardened against evolving threats so that progress can continue safely. The AI backdoor. Can tech giants seal the cracks before hackers strike again? 9. Creative rights in the AI era. Artists and tech strike groundbreaking deals. A landmark development in the ongoing tension between artificial intelligence and creative content owners unfolded this week, as a prominent artist reached a groundbreaking agreement with a generative AI startup in a dispute over the use of copyrighted art, signaling a potential shift towards cooperation over confrontation in the age of machine creativity. In a story that has resonated widely due to its cultural significance, Casey Green, the cartoonist behind the world-famous This Is Fine internet meme and comic, successfully negotiated a settlement with AI startup Artisan, resolving a dispute about the startup's use of Green's art to train its AI models. The This Is Fine cartoon, which depicts a dog calmly sitting in a room on fire, has become an iconic symbol of maintaining composure amid chaos. The fact that it became entangled in an AI copyright tussle made it a powerful example of the broader concern among artists and content creators about how their works are being scraped and utilized by AI systems without compensation. The agreement between Green and Artisan, reportedly reached after intense negotiations and legal pressure, includes a licensing arrangement, which ensures that the artist is compensated and acknowledged for his work's use in the startup's AI training data, rather than leaving the matter solely in adversarial legal territory. This story's resolution has significant implications for both the creative industries and the burgeoning AI sector, as it represents a possible template for how human creators and AI firms might coexist and collaborate rather than clash in costly lawsuits. For months, a wave of litigation has been mounting, with authors, artists, and media companies such as CNN, The New York Times, and music labels suing AI companies for allegedly infringing on their content in the process of building machine learning models. The This Is Fine resolution stands out because it did not end in drawn-out court battles, but instead in a mutual understanding, raising hopes that similar disputes might be settled through partnerships or licensing deals that respect creators' rights. From a business perspective, This kind of amicable agreement can be far less damaging, and far more productive legal fights can cost millions and create uncertainty. Whereas contracts and collaboration could lead to innovative ways for content creators to monetize their work in the AI age and for tech companies to access valuable data ethically. In the SaaS world and beyond, companies are watching closely. Tech firms building generative models know that large troves of data, text, images, music, are their rocket fuel, and now they are increasingly acknowledging that they must refuel with consent and compensation for the original creators. The agreement's optimistic outcome has sparked conversations across the tech and creative communities about forging sustainable relationships between artificial intelligence and the humans whose work and livelihoods could be impacted by it. Some point to this as an encouraging sign of a more humanistic approach in the tech industry, a recognition that even as we rush towards advanced AI, we must maintain the humanity and rights of creators at the core of digital progress. Others still caution that many core legal questions remain unanswered. For example, whether AI companies owe licensing fees for any and all copyrighted data their algorithms ingest, or how transformative use might be defined in this new context. Nevertheless, the symbolic weight of a beloved meme being at the heart of a cooperative resolution, rather than a bitter legal quagmire, is fueling a hopeful narrative in the AI discourse. It's a narrative that suggests we might navigate the new territory of AI in a way that doesn't trample the human talent that spurred these digital innovations in the first place. Indeed, just as space explorers consult scientists for successful missions, AI companies may find that partnering with and respecting creators is essential to truly reach for the stars of technological potential. Subtopic: June 6, 2026. This is fine meme gets justice. Artist wins and AI firm agrees to pay. On June 6, 2026, tech news outlets widely reported the heartening conclusion of a prominent AI copyright dispute, revealing that Casey Green, the artist behind the famous "This Is Fine" comic meme, has reached a settlement with AI startup Artisan over the unauthorized use of his artwork in the company's AI training datasets. This fresh update confirmed that the artist will be compensated and credited, marking one of the first clear victories for a creator in negotiations with an AI firm and offering a blueprint for how similar disputes could be resolved without protracted litigation. The story has captivated the tech and art communities alike, given the "This Is Fine" meme's widespread cultural impact and its ironically fitting theme of staying calm amid chaos, a metaphor that hasn't been lost in discussions about the rapidly evolving and often chaotic relationship between AI and artistic content. Under the agreement, Artisan will license Green's work and implement measures to ensure any content generated by its AI that draws from the meme will include acknowledgement of the original creator, setting a precedent for more respectful treatment of intellectual property in AI development. Commentators lauded the deal as a win-win. Green secures recognition and financial benefit for his creation, while Artisan avoids court and gains a model for ethically training AI, potentially strengthening its reputation. As news of this settlement spreads today, many are heralding it as a sign that cooperation, rather than courtroom warfare, can guide us through the challenging terrain of AI and copyright, fostering a more balanced ecosystem where technology's new frontiers can be explored without sacrificing the rights and contributions of human creators. Meme creators' triumphant deal: how a cartoon dog redrew the lines for AI and copyright. 10. SaaS is dead. Long live SaaS. AI reshapes the future of software. A debate roiling the tech and investment community this week centers on the provocative notion that SaaS is dead, as some analysts question the long-term viability of traditional software-as-a-service business models in the face of new AI-driven efficiencies, yet a growing chorus of experts is pushing back, arguing that the massive leaps in artificial intelligence will actually spark a renaissance for SaaS companies, not their demise. The doomsayers argument, which has been trending on industry blogs and forums, goes like this: AI is drastically reducing the cost of software development by as much as tenfold for certain tasks and enabling a flood of new automated competitors, leading to a belief that enterprise software's pricing power and growth prospects might be permanently diminished. Indeed, Public software stocks have been volatile, with some even trading at lower earnings multiples than the market average for the first time in years, reflecting investor uncertainty over how SaaS firms will adapt. However, a convincing counter-narrative has gained momentum, invoking historical lessons to suggest that when technology drives down costs and increases efficiency, it can unleash an even larger wave of demand rather than reduce it. A dynamic known as the Jevons paradox. Just as more efficient steam engines led to more coal consumption in the 19th century and cheaper, more powerful data centers spurred the modern cloud computing boom. These analysts posit that AI's ability to lower the cost of knowledge work and software production will dramatically expand the market for software and services, allowing SaaS providers to reach new customers, deliver unprecedented value, and potentially grow into an even bigger total market than before. This week's spirited dialogue about the fate of SaaS in an AI-dominated world has far-reaching implications for investors, employees, and customers of software companies. On one hand, some see the current environment as an existential test. Certain SaaS firms that fail to integrate AI effectively into their products may struggle, as clients gravitate toward those offering the enhanced capabilities and efficiencies that only AI-augmented software can provide. We've already seen some highly valued legacy software enterprises experiencing slower growth, and venture funding is increasingly favoring startups that are AI native in their approach, challenging incumbents to quickly evolve. On the other hand, the optimists, many of them industry veterans and forward-looking investors, point out that SaaS companies are inherently adaptable, built to update and iterate continuously, making them uniquely positioned to incorporate AI features at scale. These proponents argue that instead of contracting, the software industry is on the verge of exploding to meet a latent demand for knowledge work as AI lowers barriers and costs. Millions of smaller businesses and even individuals worldwide could become new software customers once powerful capabilities are available at an accessible price point. This view casts AI not as a SaaS killer, but as its greatest catalyst, heralding the arrival of a vast new user base and entirely new categories of smart services, a scenario in which the phrase SaaS is dead takes on an ironic twist, since software as a service might soon be more alive and ubiquitous than ever. Ultimately, the debate encapsulated by SaaS is dead. Long Live SaaS speaks to the rapid transformation underway in the tech sector and the human element at its core. The tagline itself, echoing the old adage about kings, suggests that while one era of software business may be passing, a new one is simultaneously rising, built on the foundation of AI. What remains constant is that people's needs for knowledge, productivity, connection, and creativity are boundless, and technology continues to evolve to meet them. This forward-looking, human-centric perspective is infusing a sense of optimism around the SaaS sector this week, leading cloud software companies like Salesforce, Adobe, and ServiceNow are not only embracing AI to make their platforms smarter, but also investing in partnerships and ecosystems to ensure their customers thrive in a hybrid human-AI future. As we close this week's report, one cannot help but notice the enduring theme of hope and adaptability in the face of upheaval and new frontiers, be it space, AI, or some combination thereof. The technology industry and its stakeholders are finding innovative, cooperative ways to press ahead, confident that we can build a future where advanced tools amplify, rather than diminish, human potential. Subtopic: June 6, 2026. Tech thought leaders reframe SaaS is dead, new optimism for software firms. On June 6, 2026, several influential tech investors and CEOs are publicly pushing back against the gloom and doom SaaS is dead mantra, offering fresh analysis that casts artificial intelligence as a powerful ally, rather than a foe for the software industry's future. In a series of op-eds and conference talks making the rounds today, seasoned venture capitalists and SaaS pioneers argue that AI's dramatic boost in productivity will lead to a surge in appetite for software solutions, not a collapse. They draw parallels to historical technology shifts. Just as the advent of broadband internet led to explosive growth of web services, they say, AI will unlock untapped demand by enabling software companies to deliver results and even perform knowledge work on behalf of users. This narrative of optimism is resonating in the markets. Software stock indexes have stabilized after recent detours, and those companies that have quickly integrated AI functionalities, showcasing features like automated coding, intelligent analytics, or advanced customer support, are being rewarded with investor interest. For SaaS employees and entrepreneurs, the messaging is encouraging, with leaders emphasizing that the industry's creative drive and adaptability are its greatest assets. The conversation today suggests a turning point in sentiment, as the phrase SaaS is dead is being repurposed tongue-in-cheek to reflect a rebirth of the sector in an AI-augmented form, a testament to the enduring capacity of technology and humans to adapt together and build bright new chapters out of disruption. Software's second act: how AI is breathing new life into SaaS. Video description. Join us for a deep dive into the top tech and SaaS financial news stories of the week, recorded on June 6, 2026. In this comprehensive report, we explore how the technology sector soared to new market highs, then faced a sharp correction, and how visionary companies are blazing trails by investing billions in artificial intelligence and space tech. From SpaceX's historic IPO ambitions and Florida's precedent-setting lawsuit against OpenAI, to Google's jaw-dropping $80 billion AI investment plan, a wave of impending AI unicorn public offerings, and NVIDIA's glimpse into AI-powered PCs, we unpack the biggest developments shaping the tech stock landscape. We also examine how an Instagram hack has exposed new AI security challenges, how artists and AI firms are finding common ground on creative rights, and why some experts say SaaS is dead. Long live SaaS, as AI redefines the future of software. This video delivers a thorough, people-focused analysis of how technology companies are navigating both promise and peril, from space-driven optimism to the human implications of an AI-driven economy. Remember, none of this is financial advice, just the week's most important insights to keep you informed. Video tags: tech news, tech stock market, SaaS, stock market news, technology stocks, SpaceX IPO, OpenAI lawsuit, AI regulation, Google AI investment, Alphabet stock, artificial intelligence, OpenAI IPO, Anthropic, NVIDIA, AI PC, cybersecurity, Instagram hack, AI ethics, copyright and AI, tech financial news, SaaS trends, futurism tech, space economy, AI optimism, tech trends 2026, stock market analysis, marketing tech, Silicon Valley news, space exploration technology, human-centric tech, innovation news. Positive tech news. Base thumbnail concept. A vibrant, futuristic thumbnail with a split image design capturing two thematic halves. The left half shows a rocket launching into space against a starry backdrop, symbolizing SpaceX's IPO and the tech industry's leaps. And the right half features a digital stock chart with upward trending lines in bright green, overlaid with tech company logos, Google, OpenAI, NVIDIA, etc.